Robschild, nothing I say is investment advice. Welcome back to Crystal Ball Reading Financial Markets. Today is January 16th, Tuesday, and we had an interesting day. Overall, we have knocking on the door in several markets. We have some markets showing breaking out, breaking down, but let's begin. Let's go through the important markets that I think are notable today. So specifically starting with the S&P 500, it's obviously kind of knocking on the all-time high door. My crystal ball says that every time it knocks, it's kind of like, let me through, and will it break through the all-time high? It's anybody's guess. This could be a very durable double top situation that plays out once we get past the October low. Then that's when that pattern can start and we can see a real breakdown in markets begin. But if the more we knock on that door, the greater the chances that we can break out higher to new all-time highs on the S&P 500. Seeing as though there are so many people that are convinced that the economy is fine, everything's fine, that we've achieved this soft landing scenario, and it looks that way right now. If all you're looking at is employment data, wage data, the people aren't losing their jobs en masse, people are spending money, things seem peachy. Under the surface, there's a lot of cracks. The inverted yield curve is probably the biggest one staring us in the face. The bond market does not believe that things are getting peachy. If you're following along with what's really going on, the Fed is, still strangling the economy on purpose, trying to slow it down to achieve this, supposed average target of 2% inflation. We'll see how it goes. So the S&P 500, my crystal ball tells me it's not bearish yet. Today we had a little bit of a down day, but definitely not bearish. It's knocking on that door, trying to get through to all-time highs. Overall, in markets, when I look into my crystal ball, there's plenty of greed. The greed gauges are still strong. High yield corporate is, we had a bit of a break today. It went down. It's nothing to get too bearish about. It's kind of seeking first 18-day average, kind of trying to find its ground, which kind of gives you the sense that markets are trying to give some kind of settling before they decide where they're going to be going next, generally speaking. Another market that was interesting to me was copper miners. They are breaking down. That's the one market that I see that is a pretty decent leading indicator that's showing that it is bearish. That this is a pattern that it was bearish, consolidating a little bit, and it's bearish again. And so that one's breaking down, which means that the markets are seeing less need for copper. That's not good. A lot of this changing of cars into electric cars and all of the infrastructure involved with changing over to more green energy, this is all copper based. And if the copper market doesn't believe good things are coming, that's not really a great sign. And so the crystal ball is saying, be careful out there a little bit, pay attention. Dr. Copper says pay attention. In the VIX, the fear gauge, we had a little bit of a pop, but not really any conviction. If you look at the chart, it's kind of, there's not a higher high. The candle is kind of small. It's kind of saying people got like poked today. The market, the crystal ball says that the market got a quick little stab in the neck, and but nothing overly dramatic going on. Again, we don't really have any really important data, very important data coming out until Friday. Really, the biggest indicator coming out is on Friday. We're all waiting for the PCE to come out, personal consumption and expenditures, and how it compares to PPI. Like how much do the producers have to pay for their stuff, and how much are customers paying for their stuff? And it gives you a sense of, where profits can go on earnings of companies moving forward. So we'll see what happens with that soon. It's a bit hazy. We don't see Friday's report yet in the crystal ball. The 30-year bond yield, it's not one that a lot of people like to pay that much attention to, because it's such a long dated vehicle. It is more speculative than the benchmark 10-year note. But still, I try to use my crystal ball as best I can to predict that market, because it has the most amount of safety and the most amount of potential capital gain. Of course, the longer duration treasuries that you have, the more potential you have, the more sensitive the bonds are to interest rates. And so that's why I really like to use my crystal ball for 30-year bonds. We had a flag pattern I had talked about in previous videos, and I was waiting to see if it was a flag that would break out higher, which was the more likely scenario, or if it would be a reversal and break down. It did break out higher today, and so we'll see where that goes. It looks like in my crystal ball and chart patterns that the target here is likely to be around 4.4% on the 30-year for two reasons. There's a trend line where it was a fight before, and there's also a gap fill, which are pretty common, very, very common chart patterns that typically end up playing out. And so 4.4 on the 30-year is what my crystal ball is telling me is where we're likely headed before potentially another reversal. And then we have the more important 10-year. It's funny, I connect these together like they're the same thing sometimes, but they're really not. The 10-year is also knocking on the door of higher interest rates, and so it's kind of, there's a fight here at right at 4%, 4.06% specifically. I wanted to mention, looking into my crystal ball, the yield curve is pretty odd right now. You have the 2-year, 3-year, 5-year, 7-year, and 10-year yields all below the 30-year yield. And so what it kind of suggests is that, the pain, to me, what I see in my crystal ball is the long-term treasury bond holders, the people that have the longest duration, are still a little spooked from this spike of inflation that we had, but the slightly shorter duration is like convinced that like the economy is going to be slowing down. It's or speed up at a slower and slower pace kind of a thing as well. The disinflation idea. So that's an interesting dynamic going on in the markets. A few other things that popped out to me today were rare earth metals. There's a ETF, REMX, that I like to follow. It has new lows. We haven't seen this low in this market since late 2020. So this market's getting kind of exciting for a potential long opportunity. Again, new lows since 2020. That's and this is an ETF of rare earth metal miners. Also, lithium miners seem to be getting cheap here. I like the ETF ILIT to follow that. This, looking at what's going on with markets and who's worried about which thing, however you look at it, my crystal ball has been telling me that semiconductors have gotten very overvalued unless they continue to get infinitely more valuable moving into the future without any interruptions. This is my crystal ball is telling me it may be a good time to be shorting semiconductors. Easy way to do this for retailers is the SOXS ETF. This is a easy way to short the semiconductor industry. The idea with this is these companies have gotten their PEs have gotten kind of out of hand. They've gotten overvalued. And what happens typically is when they're able to make that much profit, more companies start coming in and being like, hey, what's going on over there? And they start making more semiconductors. Microsoft, I think, is getting in the game a little bit now. Either starting production or upping their production, something like that. And once you have more production, it lowers the cost, lowers the earnings that the companies can make. And so this market's very, very likely, according to my crystal ball, to show some kind of upcoming short-term weakness, at the very least short-term weakness, if not leading the whole market downward from here. And then another market I like following is uranium. It still looks bullish as can be. We had a red candle, but it just is screaming higher. And then the last one I wanted to mention is China seems to have broken out of a pretty long-term bottom trend. The ETF KWEB, KWEB. It's like it holds Alibaba, JD. It's like the internet companies of China. This is starting to get interesting. I don't know if this is going to mean we're going to head to previous lows, new lows, or we're looking for potential. However you look at it, it looks like a buying opportunities starting to come in those in that area. So again, overall, there's still plenty of greed in the market. We have knocking on the door of all-time highs in the S&P 500. There's a number of markets that are starting to become interesting. And that's all for today. I hope you enjoyed, and I hope to do these videos on a daily basis, crystal ball gazing financial markets. I missed Friday because I was busy. I had to leave town for some work, but I will try to be here generally on a daily basis to give kind of a market brief around this, to be put on a little before 6 p.m. every day, between 5:30 and 6, something like that. Thank you for watching. If you're watching, I hope you enjoyed. Robschild.